Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending May 7th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is, of course, running with the bulls. Let's go take a look at what we did this past week, how things are kind of shaping up across the major indexes and the economic data out of here, Europe and China, and then we'll go take a look at the markets and just kind of see what's going on. But first, let's just switch over and let's take a look at the weekly sound bites, and we'll take a look first at the market index performance. You can see here that in the U.S., just about everything was in the green. Nasdaq continues to lag. It's pulling back. Russell is still leading the way, but it's pulling back just a little bit. Now it's still up almost 15% for the year. S&P and Dow running neck and neck, with Dow number 2, S&P 3, Nasdaq bringing up the rear. You can see the PE ratio, the forward 12-month, which is where everybody should focus, is just slightly under 23. Dividend yield for the S&P 1.37, 10-year Treasury at 1.58. So that means there's a spread of a positive 21 basis points between the S&P and 10-year Treasury to the upside for the Treasury. Now, it's still tight enough where money still wants to go into the equity markets because Treasury is still so low at 1.58%. The VIX this week came down 10.31% to finish the week at 16.69. We'll see if we can hold it. Every time we get down around these levels, the VIX wants to pop back up again. You can see sector performance-wise, we had energy leading the way for the week, and it's also leading the way year to date. Okay, and it's very strong, 8.74% for the week, 32.3% for the year. Technology, again, being a very poor performer, second week in a row that is pulled back. Staples is leading the way to the downside. Okay, and if we look at it from an earnings perspective, we've had about 442 of the S&P 500 companies report, all blowing away estimates. We're looking at a relative year-over-year growth of about 49% in overall profits so far, which is going to beat all records since FactSet started tracking them in 2008. Members, I'll go through a little bit more detail on the earnings so far for Q1 and what we can expect for Q2 of this year. Inflation also is a driver of sentiment this week. We saw Friday's rally kind of come on pretty strong, even with when we got the monthly non-farm payrolls. Everybody's expecting about 1,900,000 to 1 million. It only came in at 266,000 for the month of April, which is really a fraction of the 1 million everybody's expecting. And the unemployment rate actually rose from 6% to 6.1. Now, a lot of that, and I would agree, is attributable to the huge amount of money the government's paying a lot of people all over the country to essentially not work, stay at home. Talking to some of my friends that run restaurants and small retail stores, and they're having a hell of a time trying to find people. It's cheaper for people to stay home. They make more money, actually, so it's not cheaper. So human nature just being what it is, you could expect that. Sometimes I don't know why the government, they can't get out of their own way doing just really stupid stuff. But we're seeing that this past week. We also saw a little bit of a pullback in addition to the monthly non-farm payrolls coming in a lot lower than expectations. We did get jobless claims on Thursday. It did get a pandemic era low of 498,000, but the ISM April manufacturing activity came in at 60.1. That's the lowest since January this year, well below estimates of 65. Okay. March construction spending also rose less than expected. So you would think that a lot of the underwhelming, lower than expected economic data hitting would push markets down, but we seem to be in this bad news is good news scenario where the markets just make the assumption that with the economy coming in underwhelming, then it's going to spur the unaccompanied minor Biden administration to push even harder for more stimulus. So it's kind of a bad news is good news kind of scenario. We've been in these types of markets before. It doesn't last long, but that's what we've got going on right now. We also got a little bit of a decrease in Treasury yields this week. And, you know, if we look at it right now, yields are still extremely low. But at a high level, at a macro level, the Feds are going to have to start talking about tapering Yellen, we call her Aunt B because she's always putting out there that blueberry pie to just feed the markets more sugar. Um, she came out and kind of opened her mouth by saying that we may have to raise rates, that the markets didn't like that. And then she walked back what she said. But I think we got the sun and the moon and the stars lining up when they meet in Jackson Hole, Wyoming later this summer. I think we're going to start to see tapering talk out of the feds, meaning we're spending 120 billion a month right now on quantitative easing, 80 billion across treasuries, 40 billion across mortgage-backed securities. I think those are going to start to taper. Now, remember, they don't actually start to taper, they'll just talk about it to get the markets in the mood for that. Last time they did this, it took about 6 or 7 months before the markets actually started pulling back in earnest, but it prepped the market for it. And that's going to be enough for us to see about a 7 to a 12 to 15% pullback sometime in the summer months. I keep talking to our members about that. And members, we'll go through that again in a little bit more detail this Sunday evening for our weekly market watch. Now, if we come over here, and as I said, we talked about the economic data in the U.S. Treasuries. If we go over to Europe, we see Euro bond yields coming in just a little bit this week. And the Bank of England revised their forecast for 2021. So they raised the growth to 7.25 from 5%. Okay. They also started the tapering talk. Actually, they started talking about slowing bond purchases because they're also doing a quantitative easing program over in Great Britain. So that kind of caused a little bit of a momentary rise in their yields. Economic data continued to point to a broad-based pickup across most of the Eurozone. And we're seeing volume of retail sales growing. So I believe the Eurozone is going to start to pick up. Members, again, I'll show you some nice opportunities and where we can structure some long positions to reflect that. And then, of course, if we take a look at some of the other economic activity, and we'll throw China in there as well, you can see everybody was pretty much in the green across Europe, including the DAX. Everybody very strong double-digit growth. Okay, I mean the leader is the CAC 40 in France. It's leading all international large markets. France is up 15.03% year to date. Now, if we go over to the Asian markets, you can see the Nikkei was the lone survivor. It was up, almost 1.9% for the week. It's up just slightly under 7% year to date, but China is still in the red year to date. I mean, they're hurting. And you can see the Hang Seng is down 40 basis points for the week, up 5.3. China, the reason why they're having struggles is they've openly talked about cutting stimulus, and they're also going after the tech companies big time. And we've seen the tech companies pull back a lot across China, and that's kind of hurt China, even though they've got some strong economic data coming out. I mean, we're continuing to see capital inflows into the Chinese markets. The PMI data out of China rose to 56.3 in April. That's the fastest growth pace this year. Also, China had reported their exports in April surged to a stronger than expected 32.3% in dollar terms year over year. Now, last year they were in the thick of the COVID crisis, but still, all that strong growth, you would expect China would finish in the green and at least be green year to date, and it's not. They've almost pulled back into bear market territory. They missed it by maybe about 20 basis points of being down 20% year to date from their highs. So, but they're talking about cutting back stimulus. They're talking about controlling their credit or their debt rather, and they're saying the right things. Okay, so, but again, they don't have politicians that need to be reelected. They just do what they need to do. So in many respects, they can do the hard pulling because they're going for a decade, 2 decade kind of thing. Longer term, they want to position the yuan, which is their currency, much stronger as a competing force against the dollar. Now, if our politicians keep screwing up like they are, or we're trying to monetize our debt and just print until ad infinitum, our dollar will just get wasted. And we're going to have some huge inflation coming in longer term. And I think it's just going to do so much damage to the dollar unless our politicians get a little bit smarter than where they are right now. And that's a big lift, I understand. So what I want to do is let's go take a look at the price action and the charts. Let me just swing over here and let's just bring it over here to the, we're going to look at the daily chart of the E-mini S&P 500 futures. I'll give it a second or two to come up on the screen. And you're going to see when it comes up, we on Friday hit all-time highs. We hit up to 42, 32, 25, and we're close near the highs as well. Now, I told our members we were in a tight zone. Once we broke out, we moved above our R1 level, and I told our members once we did that, we'll make new all-time highs. We'll probably run up to 4250, maybe 4300 near term. I can see that happening with the momentum coming out there, but I also see a pullback setting up sometime from June to August. Now, I don't know the exact dates. Last time I called this last year, I said we'd pull back about 10%, and we came down just right at 10% in the S&P in September. I was calling for it in the June, July time or July time frame, and it came about 60 days late. I think this is going to come over the summer. We just got too many things setting up that would indicate that. You can see the MACD is getting ready to cross well above zero. And you can see that cross in the MACD at such a high level tends to just show the strength of the current momentum off. I mean, we were just down to 41.23 back on May the 4th. That was 4 days ago. We were at 41.23 intraday low. And now we're at 42.32. That's over 100 points, guys, 110 points since in 4 days. Just boom, boom, boom. And we're seeing this data with the economic data coming in under expectations. Again, bad news seems to be good news at this point in time. Okay. Now, what would a 10% pullback look like? Where would it go? Well, if we just kind of put it on here and just see from this current level here, and I put it down, you can see it would keep us in the green, but just north of the 2021 closing price. Now you can see I got a fib node here, I got the 2020 closing price, and I got a natural pivot point down here. So there's a lot of support here. And if I were to put my cursor right in the middle of it, that's about almost a 12% pullback. I would not be surprised at that, because if you look at the 200 moving average right now, we are about, which is amazing, we're about almost 13.5% north of the 200 EMA. So pull back to that point over the summer months. All the Feds have to do is say we're looking at tapering, and that's going to set off a chain of events that's going to see the Nasdaq fall the hardest. And then we're going to see value stocks hold on a little bit more, but everything is going to go down in this. It'll be a scare the children moment, but it'll be a great opportunity to buy the dip. Right now, you can see these dips are fairly minor in nature. And the biggest dip that we had was right back over here when we came down. I think it was in the middle of February, and we pulled back down to about right there, a little about 6% dip, okay, or 5.5%, 6% dip, right in that area there. Okay, you can see that dip. But outside of that, and then this dip here was only about, looks like about 5.1%. Okay, and then we had this dip right here, which was again minor, very minor, only 3.2%. So, 3.2%, 6%, 5%. This one's going to be double that. It should be 10 to 12%, which puts us right down in this level down here. The 200 EMA is going to hold us up. But that does not mean that we can't have momentum continuous up a little bit higher up to the 4,300. Remember, about a couple of months ago, I had told our members that I suspect we're going to have a run to about anywhere from 41 to 4,300. Now, I call the 4,300 areas around the highs for the year. I thought we would hit it towards the end of the year, but we could actually hit a high here in the next month to 6 weeks, and then not see that high the rest of the year. But we're going to get wind of it, and members, we'll look at the underlying breadth of the markets, and we'll be able to call it out fairly quickly. If we look at my FANG index, you can see here with the FANG index, we're off the highs. All right, the last high that we made was back the end of April. And this index is composed of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. These are going to get hurt in this pullback because you're going to see money rotate, continue to rotate. out of technology. Now, these are mega cap. They're holding on fairly well. But if we look at XLK, which is the tech sector, you can see here it looks similar, but we just barely are holding the 50 EMA, right? And looking at the tech sector, if I would have just put it on the peak, it looks sort of like the FANG index, but we're just barely holding on here, okay? Now, if we look at financials, XLF, and take a look at that sector, it's completely different. We hit highs, all-time highs, in fact, on Friday, because with interest rates projected to go higher and a very steep yield curve, it's very good for financials. And as I told our members, once we saw this coming, I had suggested go long financials, right? It's just really good. And then the other one that I think is going to do really well as a sector as a whole is industrials. Industrials also hit an all-time high on Friday. I mean, these charts are just through the roof. So the money rotation, sector rotation is happening, as you can see, as I showed. Now let me show you China, the tracking stock for China. Let's just get this up here. ASHR. You can see the degradation of this. You can see from peak to trough this year is about 19.3%, give or take a couple of basis points. So almost in a bearish market, but you can see here's where it closed on Friday, still below. We're in the red because we're below the open and close for the year, right? So of last year. So we're still in the red for China for all the reasons that I attributed it to. All right, so still underperforming. But let me just show you two stocks here, or two things. Let's first look at the Dow. The Dow, all-time highs, very strong chart, very strong. It's one of the strongest out there. In fact, the Dow actually is stronger than the S&P by 100 basis points year to date, right? So it's fairly strong. But then let me show you another strong one. Check out transports. And I got to move this up here. Transports also made new all-time highs on Friday. So just as a reminder, when transports are hitting all-time highs and the Dow is also hitting all-time highs, that tells us the underlying economy is still very strong, okay? Any pullback, we're going to get bought. It's going to be still a buy the dip crowd. Now, the question is, how deep is the dip? Is it going to be an official correction, or is it just going to be like what we've had over the past 3 or 4 months, which is 3 to 6%? I think it's going to be a little bit harder this summer, but have some money on the sidelines because there's going to be some great opportunities in there. If we look at the Russell, you can see the Russell, which tends to lead the way in a bull market, is fighting to stay above this trend line. You can see this trend line, which I started here back in the beginning of this year in January. It's held it fairly nicely, and it only went below it just 2 days, going all the way back to January. Now it's moved back up. And if I were to blow this chart up so you can see a little bit of a bigger view of it right here, you can see that candle is almost like a hammer. So that suggests more bullish action. You can see where the 50 EMA right here just kind of provided support. We closed back up above, but it's doing everything that it can, like the little engine that thought it could, going up the mountainside. Can it get up there? Until the Russell can get back up over 2316, I think it's going to be in a sideways chop. If it gives up to 50 EMA for more than 3 or 4 days and it can't get back up there, then we're going to see some more downside, okay? In the Russell, which would tend to suggest more downside in the rest of the markets. If we look at volatility, well, as I said, the VIX came in this year. VIX fell a little over 10% this year. You can see on this daily chart, we're in the yellow zone. So that means still caution from an option trading standpoint. There's strategies that we like to deploy across different zones in volatility. Okay, now understand this is VIX, it's not the vol futures. We've got in the vol futures normal back month and front month. If we look at the front month term structure, you can see here we're still in the green. So that's it's called contango. So there's no fear. And if we look at the back month, you can see here well deep into the green. So it's still, the term structure shows the markets are not concerned going all the way out to June. All right. So again, that's not that far out in time, but it just shows that the markets at this point in time are not concerned. This could all change inside of a few days with a couple of hard down moves. I do believe that we still have some more upside left with the momentum here as indicated by all these charts. But again, I will emphasize that I think buyers going to get a chance to buy the dip again sometime from June to August. We'll see the markets move and we'll be able to jump on it in advance. Bond market, obviously, with some of the strength there, you can see the bond market tried to get above the 50 EMA, but it failed. When we do have that pullback, you can see here money wants to go into bonds at the beginning of the week. um, bonds was up and then it came back down and closed a little bit lower for the week. But you can see during the day it was up and then it came back down. It was pushed right back down again. Now, my target for the bonds going out to about the middle of June is down to 15104. All right. So that does suggest more downside in the bond market. And then once we get down there, we'll probably get a divergence in the MACD, suggesting that we're going to go higher. We may, it could be interesting how these markets are going to shape up. Because we've got so much money in the markets, it gets a little bit screwy sometimes where asset correlations don't hold up as well when you get wide chop moves with all this money sloshing around in the market. But this is kind of what we're seeing right now. In fact, if we look at the 10-year interest rate, you can see here where it's holding the 50 EMA. My target for the 10-year interest rate near term is around 1.88, call it 1.9. So staying below 2. And if we move up there slowly, the markets can handle it. It's just the fast moves that kind of freak the markets out. Okay. The dollar got crushed on Friday. Look at that. I mean, it just got totally crushed. We had a run up here, and then it's just coming back down, and you're going to see shorts jumping back into the dollar again. Okay. I think the dollar is going to come down and make new 2021 lows. And we're going to get through the Senate, we're going to get some new spending bills that are going to continue to just crush the dollar and put more potential inflation back into the market. Okay. If we look at metals, if we look at gold, gold's trying to get some win here. Now, notice we had a key break here of gold over 1815. It broke to the upside. Remember what I said, longer term, I think gold's going to get back up over 2000. This near term break to me suggests that gold's going to want to break out. Okay. We took this key pivot out at 1815, and I think it could have a nice little run. All right. But I would rather be long silver than gold. Here's silver. You can see this breakout here. It's essentially been a sideways market in silver for a lot longer than gold. But if it can break out and clear this 28 level, it's going to run back up here fairly quickly. I like that one. Now, our trade, our preferred trade is copper. It continues to be copper. You can see this huge breakout. This was my near-term target. We broke out. I think it's going to run much higher. I think copper futures are going to continue to run. Keep in mind, if you're not a member of our group, you could have paid for our annual dues 5 times over again. There were 10 stocks that I came out with in early April. One of them was copper futures, or just copper, Freeport McMoran, and this has been a home run trade. It's just been a grand slam, and just doing extremely well for everybody. And now we're breaking out and we're making a run. A little bit of a dip may be called for, but longer term, I think copper is going to continue to run higher. It's just going to run, guys. Palladium, it also broke out. Notice on palladium, it came back and had a perfect retest of the prior highs, right? You can see right here on that high, and then it came right back down again, and we'll blow it up so you can see it. Almost to the penny, it just came right down and retested at high. That's almost like a hammer candle, not quite, but close to it, which would suggest there's going to be more upside. I would like to get a little bit higher, and then I would be interested in looking at shorting that sucker. And then, of course, if we look at oil, Oil is moving back up here to this level. Bull put spreads, bull call spreads, unbalanced flies. These are great ways to trade the oil markets and the option market. Unbalanced call condors, or you could do an unbalanced put iron condor as well if you want to play this. And I think they make a lot of sense. Okay. I think it's going to have a hard time getting up here around the 70 area near term. If the markets, if we get that 10% pullback, you're going to see oil pull back. I think not as strong as the equity markets. It'll be a little bit of a hedge, believe it or not. And then, but it'll offer you an opportunity to jump back in long again. Okay. So oil is just a nice little play. This was another one that I called out to our members. I'll point it out to you guys on our weekly roundup this weekend. Devon Energy, when it was down right in this area down here, I said it's going to be running up. This was our first target up here at 26.68. You can see it hit it. We're going to get a little bit of a divergence. It'll pull back a little bit, but I think it's going to run much higher. Okay. And then, of course, there is just to give you a quick overview, this is corn, right? Look at the corn. Commodities through the roof. Okay. If we look at soybeans, left to right, straight up, through the roof. Wheat, it's not as strong, but look at this, just straight up. So when you got the commodity complex in ag, or the ag complex just going through, it's just going to flow through. Oil is expensive. Ag is expensive. Copper is going up. We're seeing increases across the board. Take a look at lean hogs. I pull back a little bit here, but we just got up here. We had a beautiful divergence here on this daily chart right there. It triggered right there. And then with this, it's just, that was a signal right there. We did not take the trade, but the signal was on April the 9th, about a month ago. Again, came down, find support. It's probably going to run up and then roll back down again. To show you how high it is, we got to step it back a little bit. And if you look at it, there it is right there, right? So we could not get up above this level right here. It's a very strong level. Every time it gets up to this level here, we generally run into resistance. So I could kind of like highlight it like that, right? So when we get up near this level, it just has a hard time getting up above it. But we had the beautiful divergence there in the MACD. And with that divergence, it just said, let's go short, let's play it. This is a weekly, but if we look at the daily, it shows up even more. You can see the divergence there. And now we got a cross. We're going to move back up, but it's probably going to hit somewhere in here and roll back over. But the trade was back over here on the trigger right around the April 9th, 10th time frame. Nice little quick trade. But again, still very expensive. So that just shows you where money is going. Inflation is just right around the corner, guys. Just keep that in mind. All right, that's pretty much our update for the weekly roundup. For members, I will see you this Sunday evening, our weekly market watch. If you're a non-member, I highly encourage you to come in. We're having a lot of fun this year. Okay. Take care, everybody. Ciao.